We start off with the big story of the day, the Federal Reserve hiking rates for the second time this year. Let's get straight to Steve Leisman, who was at the news conference with Jerome Powell earlier today. Steve.
Thanks, Melissa. Yeah, and more to come. The Fed raising rates by a quarter point. The new range is 1.75 to 2.2%, and it signaled further rate hikes ahead and what Fed Chairman Jerome Powell described as a robust U.S. economy.
I would say that the economy is in great shape. If you look at household surveys, confidence is high. Look at businesses, confidence is high. If you survey workers about the job market, they'll say that it's a really good environment to find jobs. If you survey businesses, they'll say that workers are scarce. So I think overall we have a really solid economy on our hands here. And so what we're doing is we are trying to conduct monetary policy in a way that will sustain that expansion, keep the labor market strong, and keep inflation right at 2%.
Most on the Fed believe the economy is now strong enough to withstand an additional 2 rate hikes this year. The previous consensus was for just 1, and the Fed is now seen going above its long run rate in 2019. You can see that right there. The long run rate's 2.9, but it's going to go above that in 2019. There were other changes announced by Powell as he moves increasingly to put his personal stamp on the Fed that he took over in February, including a press conference now following every meeting that begins in January. Powell cautioned it did not mean any change in policy. He said the Fed is taking a wait-and-see approach when it comes to fiscal policy and how much it'll boost the economy. Powell said business leaders, though, have indicated concern about trade policy. And Powell is showing himself to be a man or a chairman willing to answer all questions, but guys, in fewer words than his predecessors. One sign of that, the Fed's policy statement now just a single page for the first time in quite a while, Melissa.
It was, 300 plus words, and the news conference itself, Steve, was under an hour, so really record time on the part of Jerome Powell.
Yeah, but it doesn't feel like he's leaving questions unanswered. He's just got a different attitude towards all these things.
One of the questions that he did field, Steve, was about the yield curve and the flattening that we were seeing. And in fact, in today's session, we saw the yield curve flatten to 0.39, so 39 points, which was extremely, extremely narrow. He made it seem to me like there was a certain amount of that was just out of the Fed's control, and maybe that wasn't reflective of what the economy is actually doing.
Right. So there's a bunch of theories on this. One theory is that this has to do with both the Fed raising rates and the bigger deficits that are out there. Powell suggested that, but there's another idea that it's the market saying no mas, and the market is saying that you're going too far. And the big question to start asking now is, will this Federal Reserve raise rates to a point that it would essentially invert the yield curve? I've talked to several Fed officials publicly, as you know, Melissa, who have said they would stop before that happened. So that's something that's going to limit how far the Fed's going to go. If we went into a meeting at 0.25 of a yield and the Fed was forced with the question of raising rates, it may not do it.
Interesting. Steve, thank you so much. Steve Leisman in Washington for us. By the way, 0.39, the narrowest the 2s10 spread has been since September 07. It was a whipsaw day. Take a look at this intraday. Whipsaw day for the markets. The Dow swinging between gains and losses, but ultimately selling off into the close. So with a clear path ahead, forecasted by Fed Chair Jerome Powell, what do you do now, Guy?
Well, look, I think Tim said it last night. He thought this Fed was going to be hawkish. He thought the tone would be hawkish. Tim was right. I thought that the M&A activity, or at least the opening up of M&A, would actually sort of supersede that hawkish tone. I was wrong. Market sold off. What do you do now? Listen, for context, the S&P's basically had a 200-point rally unabated from that 2580, 2600 level to the current level. So today is not a big deal in a vacuum. But again, the Fed is in play. And it's interesting that they were as hawkish as they were. I thought that big tech traded well. Thought the banks were trading well. But what concerned me the most today was the fact that banks rolled over. Goldman was having a big day, basically closed slightly higher. JP Morgan lower, Bank of America lower. So maybe the euphoria of the last couple weeks, at least for the short term, maybe we're in for a little move to the downside.
It seems like it goes back to that yield curve, though, going narrow. It does.
I mean, you just said that it was the tightest yield, the flattest since September 2007. You know what happened in November 2007? The S&P topped out. You know what happened in 2008? We got that recession that Tony always says that comes after the inverted yield curve.
Although he says we have 18 months before for it.
Right, and who knows? But I think what goes back to Jay Powell said about the deficits, what Steve just mentioned, is we've never had this sort of situation coming off of rates being so low, with deficits going high, with the sort of fuel that was just put on the fire here. It's totally going to be different this time, guys. I mean, that's just a fact. And when I look at the market today, I looked at the banks. Yeah, they rallied a little bit for a second. Well, how this thing plays out, it's going to be different. I mean, we have the Fed chair just telling us that, they're going to stop raising rates before the yield curve inverts. All right, good luck with that, trying to fix that.
Here's, first of all, I thought today's press statement was extraordinary. I think there were things in there I did not expect to hear the Fed say, including, first of all, this is a Fed that now is acknowledging fiscal policy. He talked about incredible demand. Janet Yellen would have said, let's wait and see till we actually see that flow through, unless they're seeing it very differently than how they're acting right now. He talked about demand through 2019 and 20, and then he talked about the supply side. He also said two things to me that tell you he's a lot more hawkish than this sounded like. First of all, he tells you the economy's in great shape, and in the next sentence, basically, he tells you that labor is scarce and that workers are hard to find. That is such a recipe for wage inflation, which is the Fed's biggest issue. Look, bottom line here is if people think that this Fed is going to go softly, I don't think so. This is a guy that thinks this economy deserves much less accommodation. And one more thing, sorry, Mel, but he's taken away all the toys. He talked about taking away this technical aspect of the IOER, which, we don't need to get into that. The bottom line is this was a policy statement where he said, I'm going to tell you we're not changing a thing, but I'm changing a lot.
So isn't it extraordinary then that the markets really had very little reaction if he was actually much more hawkish than people thought at the surface?
Oh, no, I think that the expectations were in line. I don't think he was, he was painting a picture of extreme hawkishness. I just think the market was hoping for this. I really do believe it. Looking at investors, talking to investors, what their expectations were, this, in my opinion, is a very, very benign statement. I think he handled it very well. And I think the market in general, I think it's off to the races. I think we continue to move higher.
Let me tell you what wasn't benign.
That's not my interpretation.
Let me tell you what was not benign. I think the price action in the home builders today was not benign. I think the inability for financial stocks was not benign. The inability to see what all these retail stocks, what they've been doing over the last couple months, and that was like, oh, they're out of the woods. Did you see how they reacted? So to me, I just wanted to. So listen, this is really important. I agree. This is what I'm saying, is that maybe all of this tax cut stuff got into the market, into the economy in Q1, right? And we kind of overshot it. Now,
we're talking normalization when 19 and a 19. I mean, we're talking a ways off. The market is not focused on 2019 from that perspective, and we're very much more short-term focused right now. Will volatility pick up? Absolutely. But today's commentary, in my opinion, it is still risk on.
So short-term, what do we do?
Quickly, though, I'm going to answer that question. But one of the things that scared me that Steve touched on and Dan just talked about was the fact that we will stop raising if we are in danger of inverting the yield curve. That implies their belief that they can somehow control the back end of the curve, which, in my opinion, they don't, right? I don't think the market controls that. So, yeah, they might be able to stop the front end from going up, but can they stop the back end from going down? That, to me, is something they should talk about. What do you do today? Well, I did think tech traded pretty well. Again, we mentioned AMD last week. That had a big day on what was a lousy tape at the end of the day. So there are individual names that are still starting to shine. But again, the underperformance of the banks on a day where they should have actually performed was alarming to me.
We're 2 weeks away from CCAR, Tim. What's up with the financials?
Well, look, I think this is banks, or I think the market is misinterpreting the earnings power that banks have. I actually think maybe we're not 2007 banks earning power, but we're certainly not 2012 banks earning power. So, I remain long banks. In fact, I don't think you have to trade this around so much. I think the inverted yield curve, as I pointed out, has been a time when banks have done very well, and bank stocks from 2006 to 2008, until they didn't so much, did very, very well. So I would be, if anything, from this Fed, I think they're going to go two more times this year, and I think you buy bank stocks.
Well, our next guest says there are 3 stocks to buy off the Fed's rate hike, including some financials. Let's go off the charts with Robert Sluymer of Fundstrat Global Advisors. Hi, Rob.
Hey, Melissa. Thanks very much. Let's take a look at the market as a starting point, because we've had a big run, not only in the S&P, but certainly in the small caps and the NASDAQ. I think there's a couple of points. Look, the S&P's bounced off the 200-day very nicely. That's terrific technical action. It came right off of this downtrend that was in place from the January highs, right off that 2,700 level. And now we're getting into some resistance right around that 2,800 level. So it's not surprising to see a bit of a pullback. When you look at the NASDAQ or if you look at the Russell 2000, they're way up. They're way overbought on a very short-term basis. So a pullback is not anything to be worried about, in my opinion. I think the technical action generally is still pretty healthy. So what do you do? What do you look at? I actually have to agree with Tim and a lot of these banks. The big banks, with some of the weakness that we've seen tied to Europe, have pulled back to 200-day moving averages. This is pretty good action. They break the 200-day back in early June of 16. They touch it back here, and now they're right back to support at the 200-day. It looks very timely to me. When you look at the relative performance, yeah, it's faded a little bit. But what you're seeing here is a full half year of a consolidation. Those are pretty timely entry points as the market rotates from one sector to the other. And we see that in two other financials as well. So, for example, JP Morgan, again, through the 200 back in June, off the 200 here, off the 200 here, and again, back at these levels. So it's now into support. It's starting to bottom. I think despite the action that you saw today, and I'd say that the bigger banks acted better than the regional banks, I think that they're really timely entry points despite the debate about what's happening with the Fed. And the last point, we'll look at Morgan Stanley. It's a weaker name. It's underperformed. But again, I think it's very timely here. Off the 200-day in the middle of 17. Right here, right now, it's at support. And again, this relative strength, while it's weak, I think that's an opportunity. You've seen a drawdown and a pause in these stocks. I think this is where you buy the names.
Rob comes over, I think, right?
Are you asking or are you stating?
I'm basically stating, because I basically...
You run the show. It's your show.
Brian will bring the chair and things on.
Hey, Rob. What's up, man?
So you mentioned the big cap bank stocks. A lot of people right now are favoring the regionals on the notion that they'll benefit from all the things that the big caps will benefit, but also there's a possible consolidation play as well. How does KRE look? How do some of the smaller ones look?
The regionals have ripped. They've had a great move. They've been leading. There's certainly been the bigger play in terms of rates moving higher, but I think you can get a rotation back to some of the laggers. I think the big cap banks are more timely from a technical standpoint than the regionals at this point.
So Mel just asked the question, though. We got CCAR a couple weeks. Why don't they act better? Why is Citibank down 10% on the year? It's down much more from its highs. I mean, isn't the market a discounting mechanism? Or isn't it supposed to move in front of this sort of stuff? So to me, I'm sorry to reiterate your question, but
I'm going to.
Just reiterate.
We've already reiterated.
No, because apparently I didn't have the right answer, so I want to hear Robert's.
Well, it's just technical. Look, I think from the standpoint of the market just rotating from one group to the next, you've run the regionals up. The big cap banks are down and out. We've seen it sector after sector. We talked about the staples a few weeks ago, oversold, getting a bounce. The market's very good at regurgitating and moving through rotations. I think the banks are set up. I'm not sure what the catalyst is, but from a timeliness standpoint, right here, right now, at the 200-day, it's pretty timely.
I'll give you a technical one then, because Nathan he tipped me off of this. We've been looking at the same thing. XLF had a huge run up into 2008, failed around 32-ish. XLF has had a huge run up over the last couple of years. Seemingly has failed now. Technicians will talk about a potential double top in XLF. Do you see one?
Here's the difference. You go back to 2008, in fact, farther back, when you look at the banks, the relative performance for the banks peaked in 2004, well ahead of the broader market. So even though you had the price moving higher, that relative strength signaled that there was a problem in the banks well ahead of what was happening in the financials. You don't see that now at all.
And lastly, we were talking about retail stocks. They ran up. What do you see? How did the charts look given today's action?
Look, a lot of them had big moves.
Yeah.
The tape's overbought. Small caps are overbought. You get a bit of a pullback. I don't think they're broken by any means. Some are disasters. Some you want to stay away from. But in general, I think overall, when you look at the equally weighted consumer discretionary sector, it's just grinding higher. I think it's still a long.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.